We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Michael Green. Mike is the Chief Strategist and Portfolio Manager for Simplify Asset Management. Mike, thanks so much for joining me today. How are you?
It's a pleasure to be here. I'm doing well.
So, Mike, one of the big things that I first kind of heard you talk about, and I think is really important to understand in this current environment, and especially, as a change that we've seen over, let's say, the last decade, is this idea of passive fund flows and how important they've been to really building the market to the point that we've seen it get to, and especially, let's say, the narrowness of where the market currently is. So if we could start there by kind of getting an overview of what that really means for the market and how you've seen that change through your studies of it.
Sure. So my work on passive really began in 2016. There was a paper written by another researcher, a partner at AQR named Lasse Peterson. He was the first to really come at this from a more theoretical framework. So there's been lots of complaints about passive as, like, why would you settle for average, and passive is worse than Marxism, et cetera. Lasse was the first one to actually challenge what the definition of passive was. And so his paper in 2016 called Sharpening the Arithmetic of Active Management referred back to a paper by Bill Sharpe, the inventor of the Sharpe ratio, one of the founders of of modern portfolio theory, in which he described the rationale for passive. And the thought experiment that Bill Sharpe went through was pretty straightforward. By definition, all active managers own the market in total. Therefore, by definition, passive also owns the market in total. It's simply mirroring what the active managers are doing, and therefore the only difference between the aggregate of active managers on an asset-weighted basis and passive would be fees. And since fees are lower in passive, that would lead to outperformance in passive. That was the rationale and thought process that largely underpinned the growth and acceptance of passive from roughly 1992, 1991, that paper came out. 1992, passive was about 1% market share. Today, it is north of 50% of all assets in U.S. equity markets. And so it's been an extraordinary growth over the last, give or take, 30 years in which passive has exploded onto the scene, and very little work was done saying, how is this changing market structure, until Lasse Peterson's paper in 2016. Now, my contribution to this was to look at this paper and say, wait a second, what Lasse identified was that during periods in which indexes rebalance, passive managers have to trade. And by Bill Sharpe's definition, that means they cease being active. Let me actually share a slide from one of my presentations that actually hits on exactly this point. So according to Sharpe's definition, this is what passive investing actually is. A passive investor always holds every security from the market, with each represented in the same manner as the market. In other words, market cap weighted. An active investor is simply one who is not passive. And Lasse Peterson's key insight is in footnote number 4, that there is a recognition that if you're always going to hold, that means you never trade. You cannot get into the market. You cannot get out of the market. In other words, it's magic, right? Now, Lasse correctly pointed out that during periods of index rebalancing, that ceases to be the case. And so during that time period, passive investors simply become systematic algorithmic investors who invest in a particular way given a change in the index constitution. My key insight was that because passive investors receive flows, or passive funds receive flows every single day, inflows or outflows, that means that they're constantly transacting. And as a result, they're not passive at all by the own definition of passive proponents. What they actually are is simply systematic algorithmic investment strategies that operate off of basically the world's simplest algorithm. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell. And once you recognize that, then all of a sudden the analysis changes radically. Instead of saying, well, passive comparison to active, you actually start saying, hey, wait a second, how does this emergence of this systematic algorithmic investor change market behavior? And that's really been the focus of my research. There's a couple of things that it very clearly does. The first is that because you're introducing investors who simply say, did you give me cash? If so, then buy. You've removed any filter in the market on something like valuation. And so this was another slide from my research in which I asked a really simple question. How do active managers actually behave to inflows and outflows? And so I was surprised to discover that nobody had really done this research. I went out and I surveyed investors and I asked a fairly simple question. You're a portfolio manager, you have 5% cash in your portfolio, so cash is not a meaningful constraint in either direction. You receive an inflow or outflow. What is the likelihood that you will deploy the funds or sell securities to meet a redemption given some type of valuation? And so these are the two best fit lines that emerge from that. The marginal propensity to buy, unsurprisingly, falls as valuations rise, right? So valuations rising causes the marginal propensity to buy to fall, and the marginal propensity to sell rises. That should be somewhat unsurprising because for most active managers, the current level of valuation is somewhat determinative of future expected returns. And so high valuations, low returns. Therefore, you're more willing to hold cash than you might otherwise be. That's not surprising. What was surprising is the intersection of these two lines at almost exactly 50-50 at exactly the market's historical valuation average. And the reason that's so interesting is because notice I didn't mention anything about interest rates. I didn't mention anything about business cycles. I didn't mention anything else. I simply said valuation. And if you build an agent-based model and you populate it with the responses from these surveys, and then you randomly add cash or take cash away, what you discover is that a market constructed of participants who behave in this manner exhibits valuation mean reversion, right? As valuations rise, you become less willing to buy, more willing to sell. That causes valuations to reverse, and so on, right? This is actually what gave rise to the Shiller PE and the cyclically adjusted PE and why it, quote unquote, worked to explain historical behavior. Unfortunately, that research came out in roughly 1994 and 1995, just as passive was really taking off. And so the question becomes, well, what happens when you introduce a new participant that has 100% propensity to buy or sell with no consideration for valuations?
And just for a little bit of context, where are we currently roughly for valuation right now in the market?
For valuation, we're at the highest levels in history. I'll actually show that chart in just one second. Okay. But in terms of passive penetration, we are now just about 50%. Right, so slightly over 50% in U.S. equity markets, a little bit lower in foreign markets. We can talk through the implications of that. But what happens when you introduce passive investors and you have them gain shares, what you're ending up doing is shifting the composition of the market away from a mean reversionary pool of managers towards a pool of managers who simply buy regardless of valuation. And in fact, because of market cap weighting, are biased to buy more of the stocks that have gone up and achieved higher valuations than lower valuations. In other words, a positive momentum loading. If you run that same model through showing passive share gain, instead of mean reversion, what you get is mean expansion, with valuations rising to levels we've never seen before, which unfortunately perfectly fits the actual data that we're seeing. And so again, here's the theoretical model. Here is the actual data for the S&P 500 with valuations rising to extraordinary levels. Skewed heavily, this should actually say median price to sales in blue and cap weighted price to sales in orange. So the largest companies become more richly valued, but importantly, everything is rising in value, right? So this is indeed the quote unquote everything bubble that is created by this framework. So we're at the highest levels basically in valuation history, even as more and more people are enthusiastic about the stock market because it has shown nothing but rising valuations over time. The recognition of this is unfortunate that it effectively means that this is a function of passive share gain. And then the question becomes, well, what happens when a systematic algorithmic strategy like this eventually gets to the point at which selling occurs? And that's where it overlaps with a trade that I'm very well known for, which was the implosion of the XIV on February 5th, 2018. This was the inverse VIX complex that exhibited a lot of the same behaviors. So it ended up, we ended up seeing effectively the XIV rise and rise and rise, with people's perception being that this made it more and more likely to outperform. And then in a Taleb Turkey type framework, on a single day on February 5th, 2018, the entire complex collapsed, went to zero. I had a significant trade on at the time that ended up paying out. But this was the exact same analysis. Effectively, once these strategies get to sufficient size, that their flows are the dominant flows. When they try to exit the market, or when an event occurs that forces them to try to sell, there can be no buyers below, effectively, that can handle the size of that type of transaction. And unfortunately, I think this is basically where we're getting to in the overall US equity markets.
So basically, when let's say the end of that passive flow gets marked, as you said, there's no entity that can come in and buy that type of selling, or that volume of selling that comes into it.
Yeah, I mean, I can give a really simple example. Let me actually jump to just to compare what these funds look like. So, this is the world's largest active fund. It's the Fidelity Contra Fund. It's about $150 billion in assets. It's carrying about $4.5 billion in cash, right? If they receive a redemption, they can use cash on hand to sell from that redemption. Mm-hmm. In contrast, the world's largest passive fund is the Vanguard Total Stock Market Index Fund. It's about $1.3 trillion just in this share class. It's got multiple share classes that take it up to about $1.8 trillion. But notice something really interesting. It's got negative $1 billion in cash. In other words, it has actually had redemptions, and because it doesn't want to actually sell, it has been using levered funds to meet those redemptions. The only way that passive handles redemptions is ultimately by selling into the market. Mm-hmm. And the size of these sales, right? The size of these potential sales are so large that they dwarf anything that the active manager community can create. Now, we've been protected from this because passive has done nothing but gain share over the past 30 or 40 years. Mm-hmm. Even during 2008, you continued to have positive net inflows to passive. It was just happening at a smaller scale. It hadn't become the dominant feature. And so, now as we get closer and closer to the point where inevitably there will be selling events coming from passive, we're seeing everything basically echo that component, right? The passive share gain is causing valuations to rise. The values at which they're getting to are creating conditions under which most active managers have no interest in owning these stocks. And even if they did, a second feature that's playing out in the active manager space is that the active manager space is actually in net redemptions, right? And so what we're actually weirdly getting is more than 100% of the flows at this point are taking the form of passive investment. On net, we're seeing those managers who select on the basis of size or value, trying to identify stocks that are undervalued, they're getting sold. And so this is actually creating a negative loading for the value and size factors that is creating the behavior that we see in US equity markets, where large caps run and small caps are underperforming or even declining in many situations. Russell 2000 has come nowhere close to its 2021 peaks 4 years later, right? Mm-hmm. So, we're looking at this. The other component is as that passive share gains, the quantity of trading that involves any sort of fundamental insight has actually collapsed. And importantly, this trading actually includes the redemptions that are coming into the active managers. And so perversely, that negative loading to the value factor is creating conditions under which we think that Apple and Nvidia and Microsoft are obviously the greatest companies the world has ever seen, for the very simple reason that their stock prices keep rising. My work, unfortunately, suggests that that is a byproduct of how we've currently constructed the market. And before anyone, jumps on you and says, well, that's because active managers outperform, the simple reality is that what we actually have seen is a series of regulatory changes that have enforced passive dominance. Importantly, in 2006, we introduced something called the Pension Protection Act. The Pension Protection Act changed 401ks from an opt-in system in which you had to choose to participate in a tax-deferred savings plan to an opt-out framework in which you're automatically defaulted in. When you're automatically defaulted in, there has to be something they default you into. That's what's called a qualified default investment alternative. In 2006, those were first established as balance funds, basically 60-40 type funds, a PIMCO bond equity combination. In 2012, under lobbying from Vanguard, those shifted to target date funds. And today, about 95 cents of every retirement dollar in the United States in one form or another is flowing into passive vehicles and target date funds. And so this is really the true crowded trade that exists. Mm-hmm. And the question becomes, what happens when they try to exit? My work, unfortunately, suggests it looks an awful lot like the XIV. But instead of happening in a, give or take $2 billion ETF, we're now talking about a $50 trillion market index.
It just, when we look at it like that, it just makes it seem so looming and dramatic of a rebalance that has the potential to really rock all of, as you said, this $50 trillion market, right?
Yeah, I think that's really the key component to it is in the United States, we've largely outsourced our retirement system to the market. We've presumed that market continues to function, but our choices of how we allocate capital influence how it behaves. The same way the rules that are put in place for how a Moroccan souk behaves or a Walmart operates influences how they behave. Mm-hmm. Right? If you walked into a Walmart and, the standard rule was everyone that walked in got hit upside the head with a crowbar, my guess is sales would collapse at Walmart, right? Yeah. Or you'd get lots of headache sale medicine, lots of aspirin would be sold. But the simple reality is the rules actually matter. Mm-hmm. And the simple reality is most people aren't studying them.
Well, and I think an interesting counterpoint to that, the idea that active managers have been far more, let's say, on balance in the redemption side, thinking about that conversely with passive funds, obviously, I think that rebalance, we can kind of point to that as the reason for part of that, let's say, divergence between passive and active. But insider selling is also at all-time highs at this point again.
Well, that's one of these really, really interesting things, right? So, insider selling traditionally has been thought of as a signal that you should be exiting, mm-hmm. right? And the simple reality is nobody cares anymore for the very simple reason that nobody cares at Vanguard, mm-hmm. right? There is no consideration of this. To give you some idea how extreme this is in terms of its impact, I actually just want to share one screen from my Bloomberg shot. So this is looking at the relationship between small value and large growth, right? And historically, small value has been an outperforming factor. This is the Fama French work with dimensional fund advisors. And literally almost to the day that we adopted the Pension Protection Act and established the QDIA as the default investment vehicle, mm-hmm. it just turned. Mm-hmm. Right. And so this is one of these really crazy things where we can actually point to a regulatory change. And these happen all the time, by the way. My firm Simplify is a byproduct of a regulatory change that was introduced in September of 2020 that facilitated the inclusion of derivative strategies, what I'm historically known for, into ETFs, creating the opportunity to launch new ETF firms. Mm-hmm. These types of regulatory changes really, really matter, but this is one that is so big and so important and so unknown, right? I used to use the analogy of the David Foster Wallace, "This is water" speech, mm-hmm. right? The graduation, commencement, a convocation at Kenyon College that he gave back in 2014, I think it was. in which he describes a scenario in which, two young fish are swimming along, pass by an old fish. The old fish shouts out, "Hey boys, how's the water?"
Mhm.
And they look at him kind of weird. They swim on a little bit further, and the young fish turns to the old fish and goes, "What's water?"
Mhm.
Right. And so this is part of the challenge. This is the medium in which we're swimming. We presume that the swimming pool is unchanged, despite the fact that we've got the heater going. Right. And so, we are unquestionably boiling the water at this point.
Mhm. Yeah, that's a great speech. I'll make sure I include a link to that in the show notes. But Mike, when we think about the, as you mentioned, this rebalance of the markets, what do you think could act as a catalyst to
Reverse it.
serve?
Yeah.
Sorry,
Reverse it.
to reverse it, or yeah, exactly, to reverse this action.
Yeah, so there's a couple of things that matter here, right? So once you change the system to one in which is very simply tied to, do you have a job? If so, then you are contributing, right?
Mm-hmm.
One of the obvious links becomes, well, a factor that you have to consider is employment. And, I've written on this. I know you read my Substack, which is Yes, I Give a Fig. And, I've highlighted some of these in my writings over time in that. But one of the key factors that has occurred is in that mean reversionary market in which active managers are theoretically looking at stocks and making forward projections and building a discounted cash flow analysis and saying, do I think the stock is overvalued or undervalued? If it's overvalued, I'm going to reduce or sell my position. If it's undervalued, I'm going to buy it, right? A recession is a signal that your cash flows are going to deteriorate in the future, and therefore it should be worth less. Mm-hmm. So you start reducing positioning ahead of the recession occurring. But if you have a system in which the allocation of capital is simply a function of do you have a job, well, employment is a deeply lagging indicator. It doesn't start to fall until the recession is already here. Mm-hmm. And so one of the things that becomes very perverse is that markets move from discounting mechanisms that effectively can tell you what is happening in the future by virtue of the wisdom of the crowds to a system that is now a lagging indicator tied to employment. And so one of the most important things we're watching for is a deterioration in employment, which in turn will lead to a decline in flows. And we're starting to see some indications that that's happening. Mm-hmm. The second component, though, that is also worth highlighting is that there is a feedback loop that is created by valuations themselves. And so the second thing to remember is that 401ks or systems of retirement are designed to fund retirement. At some point, you start taking withdrawals. Withdrawals are always going to be a function of asset level. So the total value of the asset is going to be a key driver of how much you're withdrawing. 401ks, for example, have what's called required minimum distributions. Those required minimum distributions are set by your age as a percentage of the assets held in your 401k. So if valuations get higher and higher and higher, eventually the withdrawals will overwhelm the contributions. Again, we are seeing some indications that that's happening, and that's deeply facilitated by the retirement of the baby boomers, which is an inevitability, right? They will not work forever. They've stuck around for a very long time. They've worked longer than we would have anticipated. We've repeatedly changed the rules around 401ks to encourage assets to remain there. And in the Trump One Big Beautiful Bill, we actually go a step further. We introduce the idea of baby, credits that are going to be invested, $1,000 invested in U.S. equities. Now, that's actually a relatively small sum, right? There's roughly 3.6 million births in the United States. So even if everyone got $1,000, that's only in the neighborhood of $3.6 billion, right? Mm-hmm. It's just not that much money in a flows determined market in which we're talking tens of billions of flows in any given month. But that's an example of another rule change that's basically designed to get people in early, keep them in for their entire lives, basically turn us into a whole bunch of Bitcoin hodlers. The system eventually fails, but one of the other challenges is that increasingly we have outsourced decision making by our policymakers, like the Federal Reserve, for example. They increasingly rely on market derived measures to determine should they hike interest rates, should they cut interest rates, et cetera. And as we take away that forward-looking capability from the market, we turn it into a lagging mechanism. that means that inevitably that the Federal Reserve and other policymakers are going to be driving using a rear view mirror that basically only tells you where you are once you've already crashed into the tree.
Mm-hmm. Well, as you're explaining that, it just obviously, to simplify it a little bit, almost seems like a literal Ponzi scheme as you were explaining it to me.
Well, I mean, this is one of the interesting features is that equities in this framework do become a Ponzi scheme, right? Mm-hmm. So my good friend, David Einhorn, whose discussion of some of my work in, I think it was 2022, really raised awareness of this. David is obviously far more famous and more successful as an investor than I am. So I'm quite happy that he chose to do that. But what David highlighted was the difference between endogenous cash flows and exogenous cash flows. And exogenous cash flow is one that is Ponzi-like. It requires somebody else to give me cash for the asset for it to have value. Mm-hmm. And the vast majority of equities, because they have very low dividend yields, very low return of cash on a net basis, even the largest stocks, NVIDIA, for example, didn't start returning cash on net to shareholders until around 2023, give or take 30 years into its life cycle. But those assets rely on exogenous cash flows, things like fund flows that we're talking about. What David was highlighting was the opportunity to invest in companies that have endogenous cash flows. In other words, are buying back their shares or paying a high enough dividend to give him the expected return that he requires without relying on other investors. As I pointed out, all valuations are rising. David will now accede that it's become almost impossible to identify even those securities. He finds almost nothing undervalued at this point. But bonds actually are a very different asset because their cash flows are deeply endogenous, right? All the cash flows that I get from bonds, particularly a short-dated bond, are going to be a function of cash that is paid either in interest or in return of principal. Mm-hmm. If I think about a longer dated bond, there's certainly the potential for prices to become influenced by passive behavior during kind of the center of its life, right? But at the terminal value, it's going to be worth the principal, right? So again, it has a largely endogenous characteristic. I actually think I have a chart on that that's worth just highlighting. Okay, so this is a messy chart, and I apologize. But hopefully I can explain it well enough. So this is looking at exactly that type of characteristics you're referring to. The path, if I invest $1,000 in equities, the path of possibilities is, determined by an upward slope. We expect stocks to rise over time and ultimately return more than bonds. But it can have a high return framework in which valuations rise. It can have a low return framework in which valuations compress or earnings are disappointing or whatever. But ultimately, this final price is determined by somebody else, right? Who wants to buy it from me.
Right.
In bonds, they have a totally different cone of possibilities. They basically have the same feature. You have a positive expected return associated with it. There is a low interest rate environment in which it modestly diverges, but then comes back to the same point. There's a high interest rate environment in which it falls and then climbs back to the same point. I draw the analogy, a bond basically looks like an American football in upward flight, right? It can have a low return framework, it can have a high return framework, but at the end of the day, you get the exact same back. Mm-hmm. Now, perversely, what this means is that a passive impact on equities is that rising valuation over time as it pushes it towards the top end of that distribution as passive gains share. The bond actually looks quite different. In a perverse way, it can't be nearly as influenced. And actually, as you get into what's called the belly of the curve, the tail of the curve, the duration end of the curve, it actually becomes undervalued in most situations. And so I actually think that part of what's happening in the bond markets today is the impact of passive. It's roughly at that stage of penetration that it was in equity markets around 2016, where it really began to influence this. I've actually been talking with Secretary of the Treasury, Scott Bessent, about exactly this topic. And I think it is one of the things that we should expect to see is a greater awareness from Treasury around how passive is impacting the U.S. Treasury market.
Mm-hmm. I think that this is absolutely fascinating to kind of wrap our heads around. And especially the part that this ends up affecting the bond market. So has this really, because of this market condition of passive taking over so much of the market, has that changed in some ways the role of the Fed as well as the, let's say, the data that they depend on?
It absolutely has. The question is, have they yet realized it?
Mm-hmm.
Right. So it's a little bit like driving with the idiot light on in your car. Right. It tells you something's wrong. We all know something's wrong. The question is now, do I want to take the time to pull into a service center and get it serviced at potentially high cost while losing access to my car? Mm-hmm. A lot of people simply decide, you know what, the car still runs. I don't care about the red light being on. That doesn't sound like a great strategy from policymakers, but that's currently where we are. And so, like, I would argue that the Fed is being misled. And candidly, I think most market observers spend the vast majority of their time trying to interpret the economic data in the context of the stock market, presuming that the stock market is actually telling you something about the future as compared to what my analysis suggests it's doing, which is just telling you, hey, you've got a job. You already knew that. Right? It only reacts once you don't have a job and you stop the contributions or you start withdrawing in an emergency framework from your 401k or in retirement from your 401k. And so this is the part that is hypothesis at this point, right? We have models of what happens. We have models of how it impacts it, but we don't know because we've never seen it before.
Mm-hmm. So, Michael, moving from this idea into basically what everybody's worried about and what the Fed is seemingly worried about right now as well is this idea of, if they drop rates, inflation going to be returning. So I like to try to separate this out and try to understand, let's say the monetary stimulus that they embarked upon with that combination of the scarcity of goods after COVID seemed to be, a good explanation for, let's say, CPI type of inflation that we saw over the past 4 years. So if they go back to cutting rates in reaction to whatever they finally decide that they're going to react to, and they went back to a fiscal type of stimulus only, would this result in the same type of inflation, let's say asset type inflation, that we saw after 2008?
Well, I think that there's a couple of things that are worth highlighting, right? So one is, there's this general idea that cutting interest rates is going to be inflationary. Mm-hmm. It can be. It can also be contractionary, and so this is worth emphasizing. When you look at an environment like we have post 2020, in which there is an extraordinarily high level of assets invested in things like money market funds, it's about $7.5 trillion that's invested in money market funds at this point. And very little financing is happening on the corporate side or on the household side at the short end of the curve, right? So there's very little adjustable rate financing. There's very little commercial paper in use as compared to what we had going into 2008. And so when the Fed hikes interest rates, perversely, the impact that it has today is to raise incomes for those who have short-term assets, things like either a money market fund or savings in a bank, et cetera. Their incomes are going up. And the fiscal transfer component of that interest expense is actually now probably the single most sizable component of the US budget. It is now past defense in total spending and is rapidly approaching that of Social Security and Medicare combined. If we cut interest rates, that fiscal transfer falls. And so it actually becomes theoretically contractionary. I think I have a chart on that. So if I do a balance sheet analysis and I basically look at the effective rate, this is actually a couple of months old now, and the quantity of corporate debt, the quantity of that that's floating, the quantity of CRE debt that's floating, et cetera. If I cut interest rates by 50 basis points, it basically lowers the interest expense by about $37 billion on the private side. On the flip side of that equation, though, remember that all that debt is somebody else's asset. So things like bills are sitting in money market funds. There's reserves at the Fed that are paying. There's CDs at banks, et cetera. And the combined floating rate on the asset side of the equation is actually almost twice that of the liability side of the equation. And so if the Fed cuts by 50 basis points, the risk is actually that you're lowering fiscal transfers, you're reducing income to the private sector, all else equal, that actually is disinflationary, not inflationary. And, there's another component, right, which is just looking at things like stock market wealth. Well, the marginal propensity to consume out of stock market wealth is really low. It's about 2 to 5%. The marginal propensity to consume out of interest income is incredibly higher. So it's 50 to 90% is the typical marginal propensity to consume that's associated with interest rate impact. And so again, when we run through this, we're like, look, the stock market doesn't really explain the consumption behavior we're seeing. The increase in interest income that's flowing through to the private sector does a much better job of doing that. And so I just keep coming back to the same place as I say, wait a second, there's this presumption through what's called the Euler coefficient that by lowering interest rates, we're going to spur credit and lending activity. I just don't see that. I just, the vast majority of the activity that we're looking for is refinancing of existing securities, not new investment or fantastic, new spending activities. It's simply paying down the debt. And so those lower interest rates are not particularly stimulative until you get back down below the levels at which the debt was last financed, which happened in 2020 and 2021 when interest rates were effectively zero. So we got a long way to go before these interest rates become meaningfully stimulative.
Right.
The second component is that if you actually think about what drives inflation, as we saw in the 2020 time period, there's two factors that play through. There's the supply side of the equation. And hiking interest rates is certainly not going to help you on the supply side. So cutting interest rates could theoretically stimulate investment that causes supply to expand. That would again be deflationary or disinflationary. But on the flip side of that, if I think about the demand side of the equation, is cutting interest rates going to affect that? Again, I come back to, well, it's actually possibly going to reduce net income levels. And so, that becomes a negative. Then the last component is really what is the underlying driver of demand-based inflation? And the most important factor that plays through in demand-based inflation is simply population growth. It's really more accurately labor force growth. And most people think about labor as being a disinflationary impact, right? If I have more labor, that actually reduces my cost of manufacturing stuff. But that forgets that the reason why people labor is because they want to consume. The statement of joining the labor force is possibly the single most inflationary statement you can make. I don't have enough. I want more, right? Do I become immediately productive and do I begin contributing? No, first you need a suit and you need an office and you need a computer and you need a car to drive to it. And you probably want to have a dishwasher to do the dishes you didn't have time to do because now you're working, right? All of these factors end up driving effectively an outward shift in aggregate demand that hits before the supply response can emerge. And so periods like the 1970s that saw persistent inflation, we use the term stagflation all the time to describe the 1970s. That's absolutely ridiculous. The 1970s had the most rapid rate of job growth in any decade in US history, with half the population levels that we have today. Right? That's an extraordinary recognition that what we actually saw was simply a population-driven boom in which women and minorities entered the labor force, formed their own households, demanded cars and dishwashers, etc. That outward shift in aggregate demand is really what caused the inflation of the 1970s. And so we actually look at that inflation in the 1970s. I mean, it just matches up perfectly with the labor force growth components, right? Now, what happened in 2020 was totally different. We shut the world down. We reopened it. Was it tied to labor force growth? Well, definitely a component of it is people re-entered the labor force. They had new jobs. They needed new capital equipment. They needed home offices. They needed all sorts of stuff, right? And that contributed to an outward shift in the aggregate demand function. But the simple reality is we are now going back to labor force growth that is in the neighborhood of sub 1%. It's about 0.4% is what we're running at currently. this is not an inflationary environment unless we choose to make it so. Mm-hmm. And choosing to make it so would be much more like the Biden era stimulus, in which we decide everybody should have whatever they want, regardless of whether they've earned it. We should suspend student loan repayments. We should not report to, buy now, pay later to credit agencies, all those sorts of things that manifested themselves that allowed that aggregate demand to be both significant and credit enhanced. Those are now all gone, and it's headed in the opposite direction. And so, if we look at what is actually transpiring right now, I'm not the least bit surprised that broadly disinflationary pressures, PCE, if we properly adjust for the housing component, is now printing right around the 1% range. This is the market-derived measures that Powell has begun to refer to. It's just not a crazy runaway inflation environment. Can that change? Of course. Can we make bad policy choices? But man, I'm not really that worried about the interest rate cut. What I'm much more worried about is the fact that Powell was late to hike interest rates and then hike them far too far. Mm-hmm. Right. So we now have amongst the most positive real interest rates that we have in living memory. The absolute level of real interest rates is very, very, very high. That's creating conditions under which we're experiencing increased credit distress, both at the household sector and at the corporate sector. And if it's not addressed in relatively short order, it would just pull forward a lot of the concerns that I have around job loss and everything else.
And again, just to kind of reiterate the importance of the jobs numbers, it seems like this is again all about jobs. And what are there any metrics that you're particularly looking at to kind of understand that as that catalyst that we went over?
Well, there's two or three factors that are playing into the jobs story, right? One is the fact that we have the tremendous uncertainty around both interest rate policy, what is the Fed going to do? Mm-hmm. And then we also have the uncertainty that's introduced in the technological sphere by the growth of AI or LLMs and the potential for services automation. This is creating an environment of uncertainty, and the response to uncertainty is not to fire people, right? You don't walk into the office, you're like, gosh, I really don't know what's going to happen over the next 6 months. I should just fire all my employees, right? Like, that's not your reaction function. Your reaction function is to begin preparing for that, right? You start saying, okay, how many people can I cut? Can I rank my people on the basis of performance? Can I identify my top performers and retain them, et cetera? Which is everything we're hearing from all of the large companies at this point.
Can I also adapt to the new systems that are coming into place that don't cost me necessarily as much as these high dollar, high value employees?
Absolutely correct. Right. And so the payback, and it becomes particularly intense at the starting end, right? Do I hire a new crop of interns or a new crop of college graduates, given my uncertainty about how my business is going to develop? No. Right. And so what we have experienced is the highest levels of unemployment in a non-recessionary environment for new college grads we've ever seen. Mm-hmm. The general oversupply of knowledge workers who are directly affected by things like LLMs and AI has exploded. I'm quite a bit older than you. I'm in my mid 50s. I actually just turned 55. When I graduated from college, less than a quarter of the U.S. population had a college degree. Today it's 50%. Right. And so there's far more people who are competing for these knowledge worker jobs and presuming that they have earned a place in society as a skilled worker, right, and incurred the costs and debt associated with that requires them to participate. That has led to an increase in the unemployment rate for college grads to the point that there's very little of a college premium that exists. Mm-hmm.
So, Mike, with basically Trump's goals at this point, trying to reshore manufacturing, trying to turn around these trade deficits. Obviously, a lower dollar is quite important in that. What do you think happens to the value of the dollar if and when the Fed reacts and drops rates?
Well, all else being equal, the what's called covered interest rate parity, which often determines carry trades, et cetera, that already reflects the fact that interest rates should be much lower in the United States. What's called swap rates, or the actual private market measures of those, is nearly a full 0.5% below, or actually I think it's almost 85 basis points now at this point, below the official level of government bond rates. So the market is very clearly telling you that interest rates should be lower. The pricing of the dollar to a certain extent reflects that. We've seen a dramatic increase in hedging activity from foreign investors putting their money into the United States. That has pushed down the value of the dollar. But the ultimate impact of tariffs, ironically, once we actually start instituting them, is that it should cause the dollar to have relative scarcity, right? And so it should rise. Tariffs are simply a tax. If I tax something, I provide less of it to the public sector unless I make it up in other areas, which we don't see any real indication for. We've extended tax cuts. We haven't dramatically increased them. And so the current system, if anything, it looks to me like you're actually looking at a net contraction of the availability of dollars, particularly internationally, that should manifest itself in dollar strength. I think people got way ahead of themselves in anticipating this in the tail end of 2024, but didn't ultimately recognize that there's that interim period in which the rest of the world throws a hissy fit and says, well, you can't tell us what to do, until they suddenly wake up and like, hey, wait a second, you know what, the customer is always right. We're going to basically bend over and do what is ever necessary to maintain that source of aggregate demand outside of our country, including cutting our own tariffs, including accepting higher tariffs from the United States. I would be very surprised if the Fed cuts interest rates, and in a meaningful way that translates to a dramatically reduced dollar, for the very simple reason that it already reflects a lot of that.
Mm-hmm. As you mentioned, the tariffs and this effort to reshore lots of manufacturing, we have seen some investment come back into the US. Do you think that this is enough of a policy change to be overall positive for that employment rate that is so key here and so necessary to maintain in order to maintain this market as well?
I mean, the simple answer is we're not going to reshore significant quantities of manufacturing. If we do, we'll be using new manufacturing technologies like additive manufacturing that ultimately means we have far less labor content. U.S. labor is very, very expensive. It's the reason why when you go to get a coffee, it costs you more to buy a single coffee at Starbucks than it does to buy a series of kitchen appliances from China. It's not a joke, right? I mean, the labor content of your coffee is significant. You've got somebody sitting there. You're also probably going to a name brand institution that has capability of, basically charging you whatever they want. And they work very hard to capture you. I'm a Starbucks buyer. I'm a Pete's buyer. I'm a, Equator coffee or Blue Mountain coffee, they're all coffee at the end of the day. We never used to think about it. Now, we have to have a flat white to accompany our avocado toast. But that labor content means it's going to be expensive. The manufacturing goods, unless we dramatically increase automation, which is really simple to do, is the same thing. And so I'd just be very surprised if we see anything in manufacturing that looks any different than what we've seen in agriculture. The U.S. has become the world's predominant agricultural powerhouse. We produce more wheat, more corn, more soy in most situations. Obviously, I know Brazil produces more absolute soy. But the reality is that we have a huge productive agricultural program and almost no workers, right? Because it's so heavily automated. Mm-hmm. Manufacturing is going to head in the same direction. The much more interesting question is, are services headed in that direction as well? And so this is one of the areas of research I'm spending a lot of time on right now, which is what I call the productization of services. We're actually, for the first time, really in over a generation, we're starting to see services spending fall as a percentage of the consumption basket. And that largely reflects the fact that we are doing things like converting call center and help desks, et cetera, even driving eventually, are moving from services that we pay people to do for us to products that we buy machines to do for us. Mm-hmm. The last time this happened in any meaningful way was in the 1920s and 1930s, when we replaced many forms of household services, washerwomen, dishwashers, household cleaning help, etc., with machines that did a lot of the same things. A vacuum cleaner, an electric iron as compared to one you have to heat up in the stove, a washing machine instead of a washerwoman, right? Those all radically reduced the demand for household help, which was effectively the gig economy work of the day.
Right.
We're now looking at something very similar where effectively the gig economy work of the day, driving people in Uber or delivering their food via DoorDash, could be very easily replaced or will eventually be replaced with automation as well. Whether we're able to handle that job loss better than we handled the job loss in the 1920s and 1930s remains to be seen.
Mm-hmm. So, Michael, reiterating this, let's say, ecosystem that is so driven by passive, when this shift occurs, do we expect the same types of assets to perform the same way as they have historically, or does this shift mean something different this time because of that market structure?
Well, it does mean something different. We've actually seen examples of this, right? So let's go back to March, April time period. Perversely, what you saw was the largest stocks, right, fall the most and fall the most rapidly. The markets were effectively led down very, very quickly by many U.S. stocks that are kind of treated with the U.S. exceptionalism framework. That's just a byproduct of passive, right? So the minute you actually go to sell these indices, that larger impact is also felt by the largest companies. And it's particularly acute if it occurs, as it did in March, April, in a time period that's either around earnings, in which there's a degree of blackout on things like stock buybacks, and also the uncertainty that it creates. So firms that had very aggressive buyback operations potentially suspended them, uncertain of what the implications would be for of a dramatic increase in tariffs on their underlying cash flows, right? So when that uncertainty hits in that framework, it flows through. Of course, I have a chart to highlight why this is actually happening. So this is drawn from the work of Valentin Haddad, who's a professor at UCLA. And what we're looking at here is market capitalization in log terms. So 12.5 is about $3 trillion in market cap. There's only a few companies beyond that. And then this is elasticity. Traditionally in economics, elasticity is the measure of how much supply and demand will change in terms of a change in price. A highly elastic stock is one that I will continue, or a highly elastic good is one I will continue. I will reduce my buying if prices go up. I'll find substitutes. An inelastic one is something typically like gasoline. In the short term, if I need to fill up my gas tank, I'm annoyed when it's $5 a gallon, but I'm not going to stop from getting home, right? So I'm going to fill up at that gas station and grumble about the cost, but I'm still going to actually buy the gasoline. If I pull into a gas station and I see that yesterday's sushi is priced at $1,000 per roll, I'm going to look at it and be like, no, I don't want that anyway, right? So it's elastic in its response. In stock market terms, when we talk about inelasticity, what we're really talking about is changes in supply and demand in response, or changes in price in response to changes in supply and demand. Highly inelastic stocks are ones that have very large changes in their price for relatively small changes in supply and demand. This chart from Valentin Haddad is super interesting because we actually know that there's a somewhat theoretical relationship, which is this red line between what we would expect in inelasticity driven by market capitalization. We should expect the largest stocks to be slightly less elastic than the smaller stocks, for the very simple reason that there's very few substitutes for them. If I want to buy Apple, I got to buy Apple. I can't substitute NVIDIA for it. I certainly can't substitute American Airlines for it. But if I want to buy United Airlines, I could substitute American and Delta or Southwest with very little meaningful difference. Okay, so there's less substitutability. But it actually turns out that the empirical line is far less elastic. And this is largely a byproduct of the passive component. There is absolutely no choice. When you decide to give money to an S&P 500 fund or a Vanguard Total Market Fund, they have to buy the largest stocks. We actually see this in option trading activity, where many times these are the only stocks that are bought in response to somebody buying call options on the S&P 500, because candidly, they make up 70% of the index. And so who cares about the smallest stocks, right? I can quickly and efficiently execute using only these stocks. when we see selling, as we saw in March, April, the same thing plays through. And so these stocks lead it down. And if you remember back in that March, April timeframe, there were all these arguments about the end of American exceptionalism and how, this was yet another change. We also heard the same arguments in 2021, 2022. Value is going to make a comeback because finally we're restoring real interest rates. And interest rates mean that value far off into the future, like growth stocks, is worth less. Therefore, people will pay less for them and they'll be attracted to value stocks. That lasted about 2.5 minutes in terms of its impact on the markets. Mm-hmm. The simple reality is that flows are determining what we're experiencing. And so when we have outflows, it's going to be the largest stocks that perversely start leading it down. And the offset to that ultimately will be things like share buybacks, et cetera, that can positively contribute. But it basically start playing the game in reverse, right? I would expect small value to outperform. I would expect international stocks to outperform, even though in traditional metrics, those are riskier, more cyclical, more economically sensitive stocks.
Mm-hmm. So, Mike, does this same, let's say, market condition in some ways, does that extend into, let's say, the value of Bitcoin and this concentration in the holding of Bitcoin as a market, and what do you take into account when trying to understand its real value?
So there's a couple of things that are worth hitting on Bitcoin. And again, I have a very strong view on Bitcoin that ultimately it is a true Ponzi asset, meaning the only value that it derives is from other people deciding it is worth a lot. Mm-hmm. We can talk through some of the mechanics on it. Bitcoin is super interesting because it has effectively a fixed supply, or a largely fixed supply. The demand factor is really the only thing that drives it. If we take that same analysis, and I'll just show very quickly here, like what's driving Bitcoin prices at this point, almost all of the behavior of Bitcoin can be explained by fund flows at this point. Right. So this is literally just looking at the change in Bitcoin held in ETFs relative to the change in price in Bitcoin. You can see that any 1 month change in Bitcoin price is very well explained by the change in Bitcoin held in funds. And this is pretty remarkable when you consider that there's tons of participants right now who are trying to replicate the MicroStrategy approach, or I guess it's called strategy now, the approach of we're going to build a Bitcoin treasury. So there's significant amounts of corporate buying that I'm not capturing here, by the way. And it's still, like, interestingly enough, given the accumulation, Bitcoin is underperforming what we would expect slightly. That tells me that there is net selling from whales. It's the same thing that are original holders of Bitcoin. Very similar to that idea of insider selling in corporations. Nobody cares, right? It does affect the price, but at the end of the day, nobody who is deciding to build a Bitcoin stockpile in their treasury is saying, gosh, the insiders are selling, maybe I should be thoughtful about this. No, they're just trying to capture the premium associated with it. When the ducks quack, you want to feed them. Bitcoin is it is a super interesting asset in a variety of ways, but that feature of scarcity is what has convinced people that it is money, right? That somehow or another we can have an endogenous monetary system that emerges from a peer-to-peer payment system that has largely failed as a peer-to-peer payment system. Unfortunately, it turns out that scarcity and that fixed cap of Bitcoin also changes the game in a very meaningful fashion. Because there will only be 21 million Bitcoin, at least according to its current programming, and because give or take 20 million of those have already been created, the distribution of who holds Bitcoin is largely fixed. There is no real mechanism for the remaining 7.5 billion people in the world to get a hold of Bitcoin in any meaningful way. Bitcoin proponents will tell you, well, they'll just stack sats, right? It's infinitely divisible. Well, infinitely divisible doesn't change distribution. It just means that you can have more decimal points, right? And so what we have seen in Bitcoin is continued concentration of wealth, which is exactly what you would expect from a system that is capped in its total quantity. Effectively, Bitcoin has recreated monopoly money. There's a finite quantity. You're playing a game. You're distributing the Bitcoin or monopoly money amongst the various players. But because it is capped in its totality, it ultimately means that any mistake by any player compounds over time, and as a result, the holdings consolidate. And that is unfortunately exactly what we're seeing in Bitcoin. It's effectively an extractive system that concentrates wealth in the hands of the original holders, even though people will argue that it was a fair distribution, that anyone could have gotten it, et cetera. The simple reality is that's not what defines the system today. Mm-hmm. And so, like, if you're a huge Bitcoin proponent, I just want you to think about, like, how are your neighbor's kids going to get any Bitcoin in the future? The only possible way is that you become new nobility and you sell some of your Bitcoin in exchange for the services that they provide. Well, that Bitcoin becomes increasingly scarce relative to those services. We talk about that as Bitcoin prices rising, but that also means that everybody else is worth less. Mm-hmm. So you either have to have just like an incredible sense of arrogance that basically says, well, the world would be better off if I was the only person with money and I was directing all activities. Or you have to recognize that this is actually an inherently flawed system that, far from democratizing access to wealth, instead concentrates it.
So how is that any different, considering this concentration and the scarcity aspect? How is gold any different in as opposed to Bitcoin in that respect?
So gold is a little different, and I think it's really important to understand. First, there's nothing magical about gold, and you've read my Substack on this. I'll share this screen just to highlight this. Right, we often hear the phrase, gold is money. No, gold is an element on the periodic table. Here it is right now, number 79. And everything that is in its region, right? Nickel, copper, zinc, silver, and gold all function as coinage. And the reason they do is because of their metallic characteristics. If I go one over to the right versus gold, I get mercury. Well, mercury doesn't work as coinage because it's a liquid at room temperature. It'll, basically go through your pocket and poison you on the way. Mm-hmm. Right? Things like platinum were very difficult, but where they were available, they were used. Cadmium, again, is poisonous. Palladium occasionally used as coinage, but very, very difficult to mold. These are all, iridium is a metallic powder, right? Very, very difficult to turn into coinage. So the reality is that gold is just a metal that has been used in coinage. It is rare. It has been used in large denomination coinage, but it is just a metal. Mm-hmm. And because it's a metal and it's naturally occurring, and there's effectively an unlimited supply that is available in the universe, the reality is the supply of gold can respond to human ingenuity and price signals. And so when we were on a gold standard, if the price of gold went up relative to other goods, in other words, a deflationary episode, that actually encouraged an increase in the supply of gold, either through technological processes, things like cyanide extraction, which had a transformative impact on the quantity of gold that was available around 1900, or it can be a function of new discoveries, right? We're going to go to California, we'll go to the Klondike, or we're going to go to Nevada and hit the Comstock mines. Those allowed increases in supply that lowered the price, increased the quantity of available money. It effectively responded to human ingenuity to solve the price signal component. And that's a critical factor. Mm-hmm. Bitcoin on the flip side of that, there's nothing I can do to affect the issuance of Bitcoin, right? It has a release schedule that is difficulty adjusted. So it's the equivalent of if I sent people to increase the quantity of gold mining, there'd just be less gold, right? And so Bitcoin, ironically, is anti-innovation. It's anti-ingenuity. It's anti-solving a market signal in price. The only thing it is good for is speculation. Whereas gold actually had that both supply and demand component that allowed it to be somewhat self-regulating.
Right. How much do you think that, let's say, the crypto ecosystem or Bitcoin itself has, let's say, affected the fair market price for gold?
Well, it has definitely created a substitute, right? So the money that is flowing into Bitcoin is often money that would have flowed into places like gold. And so again, on my Substack and the piece that we're referencing, I attempted to figure out like what would have happened to gold if Bitcoin hadn't existed, and the answer is it'd be worth a lot more, right? A rough approximate increase in the quantity of gold demanded would suggest that the price of gold would probably be closer to 10,000 as compared to its current level around 3,500 if Bitcoin didn't exist. Ultimately, whether that money is going to flow from Bitcoin or whether it's just going to be destroyed in Bitcoin and therefore not come back to gold is something that we just can't know again, right? It is an uncertainty off into the future. But the simple answer is that under almost all models, it would suggest that ultimately we'll get to the point where the marginal buyer of Bitcoin recognizes some component of there is no actual value that is being created here. There is no reason for me to transfer my wealth to somebody who happened to be earlier to this game. But again, policymakers can make bad choices. We saw it in El Salvador. We're, hearing rumors of it in other places. As Yugurtha wrote about Rome, it's a city meant to be sold to the highest bidder. I'm not sure Washington, D.C. is all that different, and there's an awful lot of money in the crypto space.
So moving forward here, we're seeing this growth of the stablecoin industry. And, Scott Bessent, for example, is talking about it in some ways becoming an important source of demand for treasuries. Is that going to be, let's say, a net positive for the market as well?
I think so. And so, I want to be very clear. I distinguish between Bitcoin and cryptographic tokens. And in particular, I actually am super interested in doing a lot of work on and with cryptographic tokens, or what I refer to as digital securities. And so, it's important to recognize that almost everything in our world is still paper-based. Every stock certificate resides in physical form at, a place like DTCC, which is the centralized clearing component. The stock certificates themselves are cryptographic tokens, right? They each have a CUSIP number associated with it. They're watermarked in various ways. They historically were treated as bearer instruments. Now they're largely held in paper form that has been digitized for record-keeping purposes. But at the end of the day, they're just paper. And, paper is very powerful in that it allows you to have a series of instruction sets associated with something, but you don't actually carry it with you. So if I have a share of Coca-Cola, there's a prospectus that defines my rights as a shareholder in Coca-Cola, but it is separate and distinct from the actual shares themselves. It's stored in a repository somewhere. I can access it on Edgar. I can reference it in a legal claim, and it'll be looked up and submitted as part of the record. But digital tokens have the capacity to actually embed all that information into the security itself. And so, a CBDC-based treasury or a digital token reference treasury can have really interesting features around it. It can have fiduciary measures. It can have embedded in it KYC and AML, in other words, compliance built into the security, where it will not pay you interest unless you've KYC AML'd in the wallet that you're holding it in. Right? That would be one use of a smart token that would actually encourage compliance and the growth of trust. And this is one of the reasons I love this approach in this sector, is at the end of the day, almost all of my work suggests that, for all the celebration of the rise of trustless systems, perversely what that's actually telling you is the thing that is in short supply in society is trust. Right? And what we really want is trust. We want to know that the money that we're sending to the government is being spent on things that we actually think are valuable as compared to transferring it to Nancy Pelosi or Donald Trump and Trump coin or whatever, right? We actually want that trust. We want to reestablish that. And so digital tokens have the capacity to actually facilitate that. And I think that is actually the direction that we're heading. And so, we'll change treasuries. We'll turn them into instruments that have an on-off switch based on whether you've complied. If you haven't paid your taxes, maybe you shouldn't be receiving interest on your treasury bills, right? All of these sound like horrible state control features, and I understand why people get so scared from them, but that's because we don't trust anyone anymore, right? At the end of the democratic government system is governance of the people, by the people, for the people. It's that belief in that we've really lost.
Well, and I think it's an interesting concept to consider when we look at, the amount of central banks that are also buying gold, wanting to be able to trust the asset that they're now backing their currencies with, right?
Well, that's really what has been powering the move in gold up to this point, right? We can date it right back to June of 22, when the U.S. effectively, stole is a strong phrase, but I'm going to use it anyway, stole the Russian reserves and did something equivalent to the KYC AML and said, okay, these treasuries that are held by Russia, we're going to give them to the European Union to fund a war against Russia. You're an idiot if you think China didn't see that and think, well, I don't want that happening to me. Can you imagine if my $3 trillion worth of reserves were taken by the United States and used to finance Taiwan's defense? Right. So what are they doing? They're taking the dollars that they receive in trade and they're reallocating it to gold. And that's, it is very, very clearly driving the gold price. I still think the best description of the price of gold is Jim Grant's, which he described as 1/n, where n is faith in central banks. Right? As that trust falls, the value of gold rises.
Well, Mike, I want to be respectful of your time. I really appreciate a really engaging and stimulating conversation here. There's so many different questions I still have for you. Hopefully we can do another one soon. But is there anything before we wrap up here that you'd like to leave our listeners to think about before we do?
The most important thing that I would emphasize is this issue of trust, right? We as a society have to figure out some way to come back together again. And, I am as guilty of it as others. I get angry about things, I get resentful of things, etc. But we really do as a society have to figure out how we can start trusting each other again. And that means that we're going to have to adopt tools that encourage trust. That's one of the reasons I'm excited about digital tokens, is the capacity to do that. But they can also be used in very nefarious ways. And so the emphasis that I would make to people is look to systems that enhance your trust, that enhance your ability to trust but verify, right? And make sure that you're thinking about that in your personal life and your investments, and recognize that there is only one way out of this, and it's together.
Excellent, Mike. Of course, you did mention it, but your Substack is yesigiveafig.com as well. Excellent Twitter follow, or X, at profplum99. Mike, I really appreciate your time today and really look forward to another conversation here.
Thank you very much, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.